My name is Michael Knox, and I'm the Chief Economist of Morgans Financial. I'm also one of the past presidents of the Economic Society of Australia, Queensland Division. It's a great privilege for us today to again welcome Christopher Kent to address a meeting of the Economic Society. Today, Chris is talking about the Chinese economy in transition and how that transition affects Australia. Christopher Kent is the Assistant Governor Economic at the RBA. He's responsible for the bank's economic analysis and economic research departments. Prior to this role, Christopher worked as Head of Payments and Policy Department and as Head of Economic Research. He also spent 2 years with the International Monetary Fund, working on the Italian desk. I would have asked a question about the coincident indicator of the Bank of Italy, but I'm not allowed to in the time. Christopher holds a PhD from the Massachusetts Institute of Technology, or MIT. This is the second time that Christopher Kent has spoken to us. Last year he very kindly gave an address to the Economic Society in the Morgans Theatre at 123 Eagle Street. In my closing remarks on that occasion, I talked about one of my favourite people from MIT, Rudi Dornbusch. Rudi Dornbusch trained more heads of central banks and more Nobel Prize winners than any other economist in the later half of the 20th century. It turns out that Rudi Dornbusch was Christopher Kent's supervisor when he did his PhD. When Rudi died at the far too early age of 60 in 2002, The Economist said, "Rudi Dornbusch gave fearless advice to governments. Sometimes they had even asked for the advice." Dornbusch did not just advise governments. On the 16th of September 1992, George Soros, those of you in the market will have heard of him, made £1 billion in profit by short-selling the pound sterling. He did so on a strategy and advice provided by Rudi Dornbusch. This event forced sterling out of the European exchange rate mechanism. This was one of the major reasons that Britain retained the pound sterling and is not a member of the euro. This advice by Dornbusch is one of the few occasions when we can say that the advice of one economist made another person a billionaire. When I also tell you that this is the person who trained Christopher Kent, I know you will listen to his remarks with greater interest. Ladies and gentlemen, Christopher Kent.
Very much, Michael, for those very kind words of introduction. Today I want to talk to you about the economic transition in China. Let me just start, though, by also thanking the Queensland branch of the Economic Society of Australia for hosting this tremendous event today. And it is a pleasure to be back at the Economic Society event, having been here last year to discuss this important topic. The economic transition in China is certainly important for the Australian economy. And in Australia, economic activity is rebalancing. It's in the process of rebalancing towards the non-mining sectors following the end of the commodity price boom. Indeed, this process is well advanced. The latest data suggests that non-mining activity is actually growing a little faster than GDP. Now, as I'm sure you're aware, much of the original impetus for the commodity price boom came from the rapid rise in China's demand for raw materials. I'm getting a lot of Eventually, the global supply of commodities increased, including supply from the resource-rich states of Queensland and Western Australia. And in turn, rising supply led to an inevitable decline in commodity prices. And even though prices are still well above the levels that they started at before the boom, the extent of the decline that we've seen over the past few years has, I think, been much larger than most people had expected. Now, in part, I think that reflects an easing in China's demand for commodities over the past year or two. This has occurred against the backdrop of a moderation in Chinese economic growth more broadly. So the slowing in growth in China, that had been widely anticipated within China, as well as by outside observers. And it's really a natural consequence of China just moving beyond that initial rapid phase of growth associated with its industrialisation. But where we find ourselves now is that there's considerable uncertainty and debate around the extent to which imbalances that have become increasingly evident in China will affect the sustainability of its growth over the coming decade or so. And key concerns are, first, the economy's reliance on investment as a source of demand, and second, on debt as a source of funding for that investment. Now, our central forecast, and I want to emphasise this at the outset, our central forecast, which is quite similar to that of many other observers, is that the Chinese economy is likely to experience a further gradual moderation in growth over the next few years. The Chinese authorities, they themselves intend to keep growth, overall growth, close to its current level for the remainder of this decade. However, I think it appears that there are increasing tensions between, on the one hand, these goals of shoring up short-term growth in China, and on the other hand, pursuing the sorts of institutional reforms that would help to sustain growth over the much longer term and assist with the necessary rebalancing of demand from investment to consumption. Now, the Chinese authorities have a rather expansive agenda of reforms necessary for that transition, and they have made progress on a number of fronts. Even so, major reforms to the financial system which are needed there to improve the allocation of capital and social reforms that would help to sort of bolster consumption, they remain incomplete. So the reform process is going to take some time there, as it does in most countries. China will continue to provide Australia with the significant opportunities over the longer term, including in sectors such as agriculture, education, tourism, and a wide range of business services. Along the way, though, and this is the point I wanted to note, we really should be alert to the risk of adverse developments that could lead to a sharper slowdown in China. I thought it would be useful to share our thoughts about some of those downside risks today. I should stress at the outset, though, that that's not really sufficient. We should recognise the Chinese authorities are attentive to these risks, and they have the scope to respond if the economy there turns out to be much weaker than expected. So how the authorities are going to respond if those risks come to pass, that's beyond the scope of my presentation today, but I just ask you to keep in mind the fact that the authorities will respond so as to do the best they can to promote strong and stable growth in China. Let me just give you a potted history first, though, of China's economic development up until now. So China experienced GDP growth of almost 10% per annum on average over the past 20 years or so. This resulted in a 7-fold increase in GDP per capita in China, in real GDP per capita. And I think it's fair to say that growth of that sort of magnitude is very impressive, particularly for such a large economy over a long period. Even so, as this chart shows, incomes per capita are still well below the levels of advanced economies, including those advanced economies in the Asian region. So there's really substantial room for further development. That's what you should take away from this. The key drivers of China's growth over the past few decades have included industrialisation, which I've already mentioned, urbanisation, and favourable demographic trends, and a range of other factors have also contributed. The Chinese economy's changed significantly from one primarily dominated by agriculture to one that now is driven by the industrial and the service sectors. The rapid emergence of China's industrial economy, that's been associated with strong investment growth, which you can see here. Strong investment growth in manufacturing and in infrastructure. Even by emerging market economy standards, though, China's development has been characterised by very high levels of investment, underpinned by high and rising rate of household saving. So against that background, the Chinese government's stimulus policies, which they adopted amid the global financial crisis, they led to a boom in debt-funded infrastructure investment and construction of residential and commercial properties. While those policies supported China's economic activity and promoted urbanisation, they also exacerbated what was arguably already a somewhat unbalanced pattern of growth. Also, the rise in debt contributed to the emergence of substantial financial risks. So that's a very brief history of 20 years of China's growth. Let me talk about more recent years which has seen this moderation of growth in China. So despite that stimulus following the global financial crisis, the annual growth in China peaked in 2007, as you can see here. Just as a quick aside, something that's often missed in this, and it's worth remembering the fact that while China's growth is slower than it was currently, it's slower than it was 10 years ago, its contribution to the growth of global output is greater now because the economy is so much larger than it was then. So we should just keep that at the back of our minds. In terms of output, the moderation in growth has been reflected in a slowdown in the industrial sector, while growth in the services sector, that's been a bit more resilient. At the same time, on the expenditure side of the ledger, which is shown here, investment growth's declined while consumption growth has been relatively persistent. The moderation in growth of overall activity, it reflects a combination of longer term and shorter term factors. So I want to go through just a few of those. One prominent longer term factor has been the reversal of China's demographic dividend, as it's called. So the working age population in China has reached its peak and it's now in decline. A second persistent factor is the decline in the growth of productivity. Both labour and total factor productivity, they experience periods of rapid growth in the 1980s, the 1990s and the early 2000s, following the market-orientated reforms and increased openness to trade and investment. Urbanisation, that also underpinned high rates of productivity growth. Why? Because people were moving from relatively unproductive roles and jobs in the agricultural sector to much more productive jobs that they were finding in the cities. However, since the late 2000s, as you can see here, productivity growth has declined as the positive effect of those earlier reforms has faded. Now, as in many other economies, housing demand, that's been an important driver of China's growth. Earlier development of private housing markets, that led to a pretty sharp rise in residential investment, as shown here from about the early 2000s. But the pace of growth in housing investment, that's declined and has made a relatively modest contribution to growth of late. One long-term factor affecting housing demand is this slowdown in the growth of the working age population that I've talked about. And that means that China's also passing its peak in household formation. A shorter-term influence is the substantial rise in the stock of unsold housing in a range of what Chinese observers would describe as smaller cities, 4 million and less in population, those sort of small ones. And what happened there were developers had built in anticipation of urbanisation that didn't really materialise, at least as rapidly as they'd hoped or expected. And it's going to take some time for those inventories to be reduced, for market signals to direct future investment in housing to locations with the best prospects for further urbanisation. Anyway, I think ongoing urbanisation, the demand for larger and higher quality housing in China as their incomes continue to grow there, that's going to continue to underpin some demand for residential housing for quite some time. But as these markets become saturated, housing is likely to become a less powerful engine of China's growth. The slowdown of late in residential property investment that we've seen over the past few years at least, that's affected heavy industries producing construction materials, including steel. The weakness in demand of late, combined with earlier strength in investment, that's led to excess capacity in quite a range of manufacturing and mining industries and widespread deflation of industrial prices. So the growth of profits is not really surprising given all of that. Growth of profits in the industrial sector is now the weakest it's been since the so-called non-performing loan crisis that was characterised the late 1990s. Excess capacity in the industrial sector has been associated with the phenomenon of so-called zombie firms. So those are enterprises that they're making losses, but they're still able to attract financial resources. In many cases, these are local government, state-owned enterprises, and they have substantial social welfare obligations. So it's understandable why the powers that be would be resistant to their closure. Anyway, the supply-side reform initiative that was announced by the central government authorities late last year, that set some goals to close excess capacity, including in coal and steel, over the next few years. Evidence of poor returns in manufacturing, that's mirrored in declining returns to investment for the Chinese economy overall. Rough estimates shown here suggest that the return on capital in China has fallen relative to the average cost of finance, and that largely reflects a rapid increase in the capital output ratio since the late 2000s. So that's the moderation in growth. Let me talk about the prospects for this rebalancing that I referred to earlier. So in contrast to the weakness in profits that I've just showed you, the share of income going to labour, that now appears to be rising, reversing the decline seen over the past decade. And so it's reasonable to expect that over time, the composition of demand will tilt towards consumption and away from investment. Indeed, I think there are tentative signs, as I showed you in an earlier chart, that this rebalancing may have started over the past few years. However, we should recognise that Chinese consumption growth is already very strong, and historically, looking at other countries' experiences, it's been pretty rare for economies to experience stable and strong consumption during a sort of a rebalancing such as this. In China, as in many economies, investment tends to create sizable demand for industrial goods, and that consumption, that's likely to be accompanied by, consumption demand, that's increasingly focused on services, as it is here in Australia. So the shift in the composition of demand from investment towards consumption, that's likely to be accompanied by the need for resources to move from capital-intensive industrial sector towards the more labour-intensive services sector. And achieving that in a smooth manner, that's going to be a significant challenge. In particular, the movement of workers from industry to services, that's unlikely to be a seamless thing. It could pose risk for employment and household income. Any decline in the growth rate of household incomes, that's likely to pose a risk to consumption, particularly because in China, households are very likely to maintain pretty high rates of saving. In part, that reflects the significant gaps in the public pension and the health insurance systems and the incomplete access that many migrant workers have to social security. So in short, the limited prospects for stronger consumption growth, the declining returns to investment, those things suggest the bulk of this rebalancing over the coming years at least is likely to be accomplished through slower investment growth, and other things equal, that suggests a further easing in growth of overall activity. That's what our central forecasts have, a further moderate easing in the growth of activity. So now let me talk to some competing objectives, some of the nature of some of the risks. So the Chinese authorities, they acknowledge the challenges posed by these different objectives that they've set themselves. One key objective is what they want to do is double the level of incomes that were seen in 2010. They want to double them by the time they reach 2020. So what does that mean? Well, that means they require annual growth somewhere in the vicinity of 6.5% on average over the next few years. I think just by itself, as I've suggested, this is going to prove challenging in the face of some of these unfavourable developments affecting the longer run determinants of growth. So, for example, the prospects for a rapid turnaround in productivity growth, they appear rather limited given the gradual pace of economic reforms in recent years. Having said that, the government does have ambitious reform plans, and they have made some early, but it's gradual progress in a number of areas. So they want this growth, this strong growth, but at the same time, what they would like to do is to encourage the rebalancing of demand away from investment and to slow the accumulation of debt, at least within some of the heavily indebted corporate industries. However, over recent years, meeting these short-term growth targets that I mentioned, they appear to have taken precedence over plans to place growth and financing on a more sustainable footing. Over the past year, meeting the government's short-term growth goals, that required policymakers to pursue more stimulatory macro policies. What did they do? Well, they've achieved some of that through cuts to benchmark interest rates. There's been an easing in fiscal policy. There's been a relaxation of housing market restrictions that were in place earlier, and all of that while accommodating a faster pace of debt accumulation. So overall, these measures have tended to stimulate investment, mostly in housing and public infrastructure, more so than they did support consumption or private investment. Indeed, there's been a return to growth in housing prices of late, having declined for a time, and a pickup in housing sales and a recovery in residential investment. So these measures that they had taken to stimulate the economy are working on a number of dimensions. The trend rise in the ratio of debt since the GFC, that's continued of late. Estimates vary somewhat, but what it's done is led China to have total public and private debt rise to around 250% or thereabouts of GDP. That's still below that of several advanced economies, but it does stand out among emerging market economies given China's relatively modest stage of economic development. So the high and rapid growth of debt in China increases vulnerabilities to adverse shocks. Reflecting the investment-driven nature of the expansion since 2008, the rise in debt, as you can see here, has been concentrated in the corporate sector, as well as local governments' off-balance sheet vehicles that have been responsible for funding substantial infrastructure investment. So there's a risk, and what's the risk? The risk is that defaults on those sorts of debts could impose significant losses on financial institutions. They could lead to a general loss of confidence, a tendency for liquidity perhaps to recede in a range of funding markets. To date, efforts by policymakers to address those risks associated with the build-up in debt, they've focused on restructuring local government debt. But with regard to addressing financial risks in the corporate sector, so far at least, the central government appears to have taken a pretty hands-off approach. They're leaving it to the banks, the local governments to just address issues as they arise. Central authorities also appear more willing to tolerate some defaults in the bond market, and that's grown pretty rapidly as a source of funding in the past couple of years. So those sorts of things, that'll help improve the allocation of credit over time, but the funding channel remains vulnerable to the possibility of a sharp reassessment there of risks by lenders. So far, there aren't that many outward signs of distress in the banking system, despite falling profit growth, despite rising indications of non-performing loans shown here, albeit off a pretty low level. But the structure of the financial system, it continues to evolve pretty rapidly in China. That's raising concerns about the robustness of the funding position of some of the faster growing segments in the industry, particularly smaller banks, some of the non-bank financial intermediaries as well. One concern is that the smaller lenders that might have some large exposures to regions and industries currently experiencing economic hardship, they might suffer some losses. Likewise, institutions involved in complex sort of shadow banking transactions, they could experience problems if there's a shift in sentiment that affects funding markets and forces those sorts of activities to be unwound. It's worth noting, however, that compared with many cases of heavily indebted emerging economies that have faced financial problems in the past, compared to them, China's debt is largely a domestic debt. A considerable portion of that has arisen from state-owned or state-controlled financial institutions lending to state-owned or state-controlled enterprises. So the point of that is to some extent it allows the problem to be handled within the sort of official family, if you like, makes it more manageable in that regard. Moreover, the debt's been largely funded by the household sector, and that's sustained very high rates of savings. So although that doesn't preclude the possibility of a substantial disruption in the financial system, what it does is provide some leeway for the authorities, if it comes to pass, to ensure that the financial system remains liquid. The extent of that will depend potentially on the effectiveness of the capital controls they have in place, but that's a topic for another time. Let me draw some conclusions together. So, China's economy, it's grown at an impressive rate for 20 years or so. That growth's moderated over recent years. It's projected to ease a bit further as the longer-term drivers of that growth as they recede. Moreover, the pattern of development has given rise to significant imbalances. High and rising levels of corporate debt in the face of excess capacity, declining profitability, they suggest a greater risk of corporate default that could ultimately lead to a disruption in the financial system. Now, there have been very many positive signals from the leadership about improving the sustainability of growth, including recent calls to implement so-called supply-side reforms, trying to facilitate deleveraging in the corporate sector, trying to reduce excess capacity in key industries. Nonetheless, the direction of policy so far has tended towards more rather than less accommodative monetary and fiscal settings. And to the extent that this represents a reprioritisation of these short-term objectives over these longer-term ones of sustainability, that may increase the likelihood of a future disruptive adjustment. Even so, as I said at the outset, the authorities will no doubt respond if the economy experiences shocks that might otherwise lead to a so-called hard landing for the economy as a whole. In other words, they're aware of the challenges, and they have scope to respond if the economy turns out to be much weaker than expected. Let me just finish with a couple of remarks on Australia. I think for Australia, the primary risk posed by the uncertain outlook in China is to commodity prices, to the value of exports of goods and services. If that came to pass, a depreciation of the Australian dollar in response to any negative developments in external conditions, that could be expected to act in the usual sort of way as it does, as a buffer like it has in the past. So I focused today on a number of the downside risks, but we shouldn't lose sight of the fact that the central scenario, as I've said, over the next few years is for a gradual moderation of growth in China. And looking over the longer term, and as this chart gives you a bit of a hint about, there's a lot of room for further development of the Chinese economy, and that, I think, will provide Australia with many economic opportunities. As this chart shows, even though the value of non-rural exports, that's the line in the top left panel there, even though the value of those exports to China have declined with the fall in commodity prices, we're exporting more volumes, but the prices are lower, so the values come off. So even though they've come off, the value of other exports to China have been rising strongly of late, so services and rural goods. We're likely to continue, I think, to benefit from rising incomes in China and the associated demand for high-quality food, goods, and a wide array of household and business services, demand from China and actually the region more broadly. So let me stop there and hand the floor back to Michael, and who'll open up for Q&A. Thank you. Thank you very much.
Now, Chris has kindly agreed to take questions. Now, unfortunately, my introduction to Chris was far too short, so we have an enormous amount of time for questions. So we really do want you to put thought into the questions that you can ask Chris. I'll start with a couple of questions. Now, we will have two people moving around the room with microphones, so that if you stand up, they will come to you and you can ask the question. So I've got a couple of questions first, of course, because I was here first. Okay, so Chris, we had a panel present to the Economic Society last week, and one of the economists who was presenting talked about the China manufacturing PMI, the Purchasing Managers' Index, and about the fact that the PMI for China is calibrated differently to Europe, so that the PMI for China, when it falls down to 50, GDP growth is still 7.5%, whereas when a European PMI falls down to 50, growth is 0. But in spite of the fact that it's calibrated differently, when a China PMI is reported below 50, pretty much all the newspapers and all the media screams that the Chinese economy is in contraction when it's actually growing around 7.5%. A few years ago, the RBA did an information piece on this to correct this misunderstanding. Is there any prospect that the RBA might do something like this again?
Sure. So can I just check my mic is working okay? Yeah. And it's a good question. So I think, well, we monitor many things to do with the Chinese economy, and what you're referring to was a box we put out with a statement on monetary policy, I can't remember exactly when, but a few quarters ago. And what that was trying to do was to say, many people are dubious about the strength of growth in China according to some of the official statistics, and one, they point to GDP growth that's reported to have remained close to 7% of late, and in terms of GDP, and industrial production, which has slowed quite markedly but still growing reportedly according to the value-added statistics around the 5% sort of mark. And the PMI is something that is focused very much on industry and manufacturing, and it's just trying to give you a sense of how things are relative to sort of longer term performance. So those PMI measures have been weaker of late and suggest more weakness than maybe the industrial production growth figures and certainly the GDP figures. So I think what we did in this box is say, well, there are different ways of thinking about industrial production, and even though the authorities in China are trying to present a value-added concept of industrial production growth that's meaningful, another way of thinking about it is just add up all of the components of output. Now, that's not the same as many of the well-trained economists here know as value-added, but it might give you a sense of things that steel production hasn't gone up at all in the past year. Same is true of many other industrial products. If you add all those up, how do you get growth of 5%? Well, if you just add up the outputs, you don't get very much growth at all. That was the point we were drawing. But we're also noticing that that has other problems, and it's not a value-added concept. It's not precise. It suffers from other difficulties. But the next step, even if we take something like the PMI or take the gross output measure and say growth's much weaker in industry than you would think by value-added, which is feeding into GDP, let's call it zero growth or close to. What does that mean for GDP if we rebalance? Well, services growth's about 8%. It's half the economy. That's how you generate GDP growth estimates. Some people say is 4 or less. I think the main point is, whatever your numbers are, the growth is less than it has been in the past. And the source of weakness is in the industrial sector, and that's obviously affected Australia significantly, given that we've been exporting a lot of the commodities that fuel the industrial production.
Okay, Chris, now you're from the RBA, and my audience would be disappointed if I didn't ask you a question about interest rates. But I'm going to ask this in a very academic environment, and I'm going to talk about the Federal Reserve. In the last month, we've had commentary both from the Deputy Head of the Fed, Stan Fisher, and the Head of the Fed, in terms of the natural rate or neutral rate of interest. And Stan Fisher gave a very academic speech about this about 3 weeks ago. And he talked about how the concept had arisen from the work of Knut Wicksell, in the end of the 19th century. But he said that this natural and neutral rate of interest had been trending down in the US over the last 3 decades, and it was now sort of bottoming out. But what he said that was really struck me is that he said that they have a group in the Fed that calculates this natural rate of interest every time there's a meeting of the Open Market Committee of the Federal Reserve. And so the Fed has this information on where the neutral interest rate should be. What we saw only about a week ago, Janet Yellen also talked about this natural or neutral rate of interest. And she said it was the interest rate at which the economy could grow at potential. And she also said that that interest rate was about 1% higher than where the Fed funds rate is now. And that gave the impression that the Fed would be increasing interest rates about 1% maybe over the next year. So my question therefore is, does the RBA do that kind of calculation of the natural rate of interest like the Fed does? And of course the sneak question after that is, what's the right interest rate?
Sure. Well, and it's a good question. Well, we do look at things like estimates of the neutral rate of interest. Those are generated by estimates from various models. We run quite a large suite of different types of models. I think we're never wedded to any one model or even modelling overall. It doesn't drive our decisions, it just informs. It's a check and a balance on other things that we're doing and thinking about as we try and tell a story about how we think the economy is developing. So we're not overly wedded to models, we do look at them. I think the thing we do know, and we do say, and we emphasise this very regularly every time we put out our forecast for the economy, is there's a wide range of uncertainty. The outlook is uncertain, even where we are today is uncertain, and we're a bit reluctant to put too much faith in one particular number, one particular data series, one particular estimate to summarise how the economy is going. Anyway, having said that, I think we would agree that as part of a global sort of phenomenon, yes, the neutral real rate is lower than where it had been in the past. The neutral interest rate's lower than where it had been in the past. And that means that other things equal, monetary policy, a given level of, say, the cash rate is less stimulatory than it would have been in the past. But I wouldn't stop there. What we do know is that monetary policy has provided in Australia lower rates over the past few years, and we do think that those rates are quite stimulatory. They're having an effect on the economy. Those low rates combined with the lower exchange rate we've seen since 2013, they are helping to drive this sort of adjustment, this rebalancing that I've been talking about, I mentioned in my speech, between mining activity and non-mining activity. So I think they're part of the story behind why non-mining activity really is, growing gradually more strongly, and at the moment, by my estimates, growing a bit faster than GDP growth.
Well, that was my prepared questions. Do we have questions from the audience? Could we please stand up? Yes.
Thank you. Ken Howard from Morgans. Interested in two questions. One, the loan balance in China has grown rapidly. You're saying 250% of GDP. If I said China GDP was 10 trillion, then that's a $25 trillion number. Your non-performing loans, maybe it's a 5% type of figure of total outstanding debt. So is it that China's got a potential $1 trillion non-performing loan problem? And you're talking about the Chinese government has options. What are the options that the Chinese government has to potentially deal with a $1 trillion non-performing loan book? The second question is, you say the Chinese are big savers, so they're saving 50% of their income. How is the Chinese population exposed, if they are savers, to this potential non-performing loan situation, or is that something that would be nationalised and individual savings would be secure?
Well, good question. I think the starting point is I wouldn't get too focused on a particular level of non-performing loans, not even the ones I necessarily showed you in the chart, because there's perhaps a little bit more discretion in reporting those numbers in China than in other parts of the world. The point is they have been low, but they're rising, and that makes sense because of these weak points in parts of the economy. And I really want to emphasise parts, the industrial sector, and not all of the industrial sector, particularly the heavy industries, the mining sectors, and parts of the country like the northeast, which are more exposed to those things. So it makes sense that non-performing loans are rising, whether or not you agree with the right level that's reported. In terms of some of the options, I think what people do is they look back to a period before, and I suggested there was a period of very low profitability in the late 1990s, and that led to a significant rise in non-performing loans. And what the government did is essentially pump a lot of money into the banking system to deal with those problem loans, to keep the banks strong. So when I talk about scope for authorities to act if bad things come to pass, part of that scope is on the fiscal policy side. The central government is well placed to provide support one way or another. Their levels of public sector central debt to GDP are reasonably modest. So there's scope to do that if they can do that well, and do that timely if needed. And I think exactly what they're going to be trying to do is to provide liquidity, which they can do through other means, not just directly using the balance sheet of the government, recapitalise any banks that might need recapitalising, provide confidence to the populace that their savings, which are sitting in those financial institutions, are protected. So there aren't explicit guarantees of the banking system. Well, actually, that's not entirely true, because now there's a deposit protection scheme in place in China of a certain form more recently. But it's the government widely expected to provide a backstop to the financial system if those problems become severe and there is a loss of confidence or a loss of liquidity. So that's what I mean by the scope to do something. Let me leave it at that.
Is there another question from a table behind me? Yes. Yep.
Thank you, Christopher. Just a question about the Gene Tunney here from Economic Society. Just a question about the inflation target. There's a lot of talk about how inflation's settled at a permanently, a lower level. Would the bank consider dropping the inflation target to say 1% to 2%?
I think it's a reasonable question that gets asked on occasions. Actually, asked as best I can remember back in somewhere like 2007, 2008. by some people who weren't noticing inflation was above 3%, was on a rising trend, and that the bank was acting via higher raising rates to counteract that, as you would imagine. And they were calling for the inflation target to be increased because they didn't like rates going up. Now, there's been a bit of a reversal of that, and there are a number of aspects to that. But the thing I would emphasise about the inflation target is the target is 2 to 3% on average over the course of the business cycle, over the medium term. And what that means is, because it's of that medium term aspect, it says the bank can approach that with quite a degree of flexibility. People talk about 2 to 3% as a range or as boundaries. It's not. The target's 2 to 3 on average over the medium term. So what that means is if you take an average of inflation over any reasonable length of time, either into the future or into the past, that's the metric by which you judge whether you've met that sort of 2 to 3% target. And I think our reasonable length of time in history says, yes, the bank's achieved that very well, very successfully. So the thing I'd say about calls for, where people call for a lower target now, the arguments that suggest you want to be very careful about that are, well, if you're worried about low inflation, part of the concern is how vigorously can a central bank using their regular interest rate tool push inflation higher. And one of the important things to do is it's easier to do that if you can keep inflation expectations at reasonable levels, anchored close to your target. And I think that's the case in Australia. But if you lower the target, you actually say to people, lower those expectations. And what that means is it actually acts to push the real interest rate up, and that makes monetary policy less stimulatory and less able to achieve its goals of achieving sort of low, stable inflation over a period of time of between 2 and 3%. So you're making your job harder. And that, given the academic nature of the audience, let me just ask for indulgence for another minute more and say, on the academic side of the debate, and focus very much not on the Australian experience, but on the experience of other central banks that are close to their lower bound, their effective lower bound, if you like, what used to be called the zero lower bound, but now we've adapted that language to the effective lower bound because some are below zero. So central banks that run up against that and then have to find other policy instruments to act to achieve their objectives, the concern amongst the academic community is, well, that's a difficult place for a central bank to be, and you'd like to avoid that. And one way to avoid that is to actually raise inflation targets. So that's the academic debate, and it says be very cautious about these calls for moving things. I'm not calling for a higher inflation target by any means. I'm saying our target's worked very well, and it's a flexible one in the way we think about it. I don't think there's a need to make these adjustments in the way that many people are calling for.
Doug McTaggart.
Thanks, Michael. Thank you, Chris, for a well-balanced discussion of the risks on China. So I'll bring you back to China. But it's interesting how two different sets of eyes can see the same data and come to different conclusions. So can I just pull together some of your observations and ask you a following question? One, you point out China's a poor country. Its GDP per capita figures show that. It's got a very small middle class for an economy the size that it is, and that middle class would be low income in the rest of the world, the developed world. It is, as you point out, an old economy, and its demographics are getting worse. Its workforce is in decline, as you note. For a country with no social security nets and poor ageing households, they're saving furiously for their imminent retirement. And its consumption base is very small, 35% of GDP, and its growth rates, as you showed in one of your charts, haven't really picked up in terms of consumption. So, how is a poor, old, ageing economy focused on saving for its retirement going to become consumption-based, starting off such a low base. How good are their policymakers?
Well, I think by all accounts, and my suggestion about their impressive record over 2 decades, that so far they're not doing too bad a job over the past 2 decades. You know, to increase incomes per capita by 7-fold is pretty impressive. It's not to say they don't have problems. Many economies do have different problems. The demographic trends, which were very favourable, are less so. You know, in some ways you could say that high level of savings is a strength, at least at some point, and that's what I was trying to suggest in terms of managing some of these problems that they have in the financial system, in that they're domestic, and it's largely a domestic issue, and unlikely to be triggered by foreigners who might be in there who're providing all the savings, who might choose to exit. So in some ways that's a strength. I mean, the consumption growth already is pretty strong. You know, if you go back to some of those charts I show, and they're in my paper and online. Now, more than half of the contribution to GDP growth recorded, you know, in the vicinity of 7%, is from consumption now. So it's a growing share of the economy. It's growing slowly. It's still pretty strong. The point I was just trying to make is it's unlikely to fill a hole in a quick way, if required, through a drop in the savings rate, if things worsen dramatically on the industrial sector front, for example. So, you know, how can they ensure stable growth? Well, they have a whole agenda of reforms, including to enterprises, state-owned enterprises, the sorts of things that would make them more dynamic, and there are some very dynamic parts of the Chinese economy. It's still growing very strongly in parts, and it's to try and encourage more profitable opportunities, to shut down old ways of doing things, older industries, and encourage new ones. That's often not seamless. It can cause hiccups along the way. But they know they have to do those things, and there are often political questions as to the speed at which people will find those acceptable. Because they often, when you're asking people to shut down a steel mill that's the main employer in a town, or a coal mine, that's difficult, and people can't see what's to replace it. So they're aware of all these things. They've handled things pretty well for 20 years. You know, they've got quite a few levers and things they can do, but some of these constraints are political ones, so it remains to be seen how they manage those.
Thank you very much. That's the end of question time. Now, Chris Kent and I will now go back down to the table, and Brian Sheehan, the Managing Director of Morgans, will come up and give the vote of thanks.
All right, thank you, Michael. Thank you, Chris. Ladies and gentlemen, thank you very much for attending this important lunch today. Morgans is again proud to be a sponsor of this event, and on behalf of my colleagues and the Economic Society of Australia, I'd like to thank the Assistant Governor for his presentation today. It's fantastic for business, finance, government and the educational communities in Brisbane to hear directly from a key member of the team that is holding the levers that drive the Australian economy. Today, the Assistant Governor has given us some rare insights into the state of play with the Chinese economy, and in particular, its current influence on the Australian economy. Having spent some time in China about 2 decades ago and observed the transition since then, I've sort of come to the conclusion that trying to understand the Chinese economy is a bit like trying to solve a Rubik's Cube puzzle while driving a bicycle down a bumpy road. But certainly some of the insights we've got today have certainly helped solve that puzzle. Well, I think Doug tried to throw a spanner in the wheel. Well done, Doug. We'd also like to express our thanks to the Economic Society of Australia who facilitated this occasion. And certainly to the Assistant Governor, given your commitments, we're delighted and privileged to have you make the effort to come to Brisbane and present today. And from a local unbiased point of view, particularly looking at your Australia-China trade curve, we certainly believe that Queensland is the most normal economy in the country, with its balance of resources, agriculture and services, and tourism on the other side as well. So hopefully you may have gained some insights from your visit as well, and certainly come back and visit us again, but maybe not come on State of Origin night, doesn't look so normal then. So ladies and gentlemen, please join me in thanking the Assistant Governor for his presentation today.
Thank you, Brian, and thank you very much to Morgans for your ongoing strong support of our events, and in particular this one which you've been at from the very beginning. Thank you to NAB too, who's always had a strong presence at these events with many staff and clients, and we warmly welcome NAB as a sponsor. Also the Australian Institute for Business and Economics at UQ. Hopefully this event very much supports your mission to get better engagement between economics and business. Thank you to FINSIA for promoting the event, and we welcome FINSIA members and their guests here. We've got some events coming up for the Society. On the 21st of June, next Tuesday, Greg Upton at Morgans will provide a presentation on the outlook for the Queensland economy based on the forecast in the Queensland budget. In mid-July, we've got the Conference of Economists in Adelaide. Later in July, the Society, in conjunction with QUT, UQ and Griffith, is holding a winter school in behavioural economics targeted at high degree research students, early career academics and public policy practitioners. And perhaps something with broader appeal, on the 26th of July, Professor Leslie Mark of Duke University is talking on how to defend against collusion by your suppliers. So there may be some interest in the room in regard to that. That's a Colin Clark Memorial Lecture at Customs House UQ, and will include examples of collusion and how to use defences in response. We're working on a seminar in September on a user's guide to computable general equilibrium models. It sounds a bit niche, and no doubt is, but in fact, when someone says the company tax rate cut will do this, or the GST rate increase will do this, in the background there's some model of that sort driving those responses. So we're trying to expose the strengths and weaknesses of those somewhat arcane analyses, but nonetheless important in the background. Our web address for our upcoming events is on the flyer on your table, as well as information on how to join the Society. So this draws our proceedings to a close. Thank you again for coming, and thank you to Christopher Kent for speaking, and have a great afternoon.